Hey everyone, and welcome back to the Tesla Stock Podcast. With a crucial earnings report just a week away, Wall Street is officially declaring Tesla a must-own stock, with a new bull on the street setting a price target well north of $500. But even as the AI hype train leaves the station, a closer look at the company's record-breaking delivery number and a strange new development with the Cybertruck reveal a much more complicated picture. With the stock now trading around the $432 mark, let's break it down. Let's start with the big bullish headline. Melius Research has just initiated coverage on Tesla with a buy rating and a $520 price target. Analyst Rob Wertheimer's note is a pure distillation of the AI bull case. He writes, quote, "We see Tesla shares as a must-own. The disruptive force of AI will wreck multi-trillion-dollar industries, starting with auto." He argues that Tesla, under Elon Musk's leadership, has the risk-taking culture, the manufacturing scale, and the real-world data to dominate the first major manifestation of AI in the physical world, which is autonomous driving. This perfectly captures the tale of two Teslas that Evercore ISI described this week. They see the company as having two parts: a core industrial Tesla worth about $400 billion, and then a massive trillion-dollar call option on the future of AI. It's this second part, the AI story, that has the market completely captivated and is driving the stock higher, even as the analyst from Melius admits that the company's valuation is now mostly guesswork. The focus for the upcoming earnings report on October 22nd will be squarely on any and all updates regarding the robotaxi rollout and the progress of FSD. But while the market is focused on the AI future, a closer look at the present-day car business reveals a more complex story. Our second story is a deeper dive into that record-breaking 497,000 delivery number from the third quarter. While the top-line result was a massive beat and great for the company, a recent note from Seeking Alpha points out two issues lurking under the hood. First, Tesla's deliveries were 10% above its production. The company only produced about 447,000 vehicles, which is actually down year over year. This indicates that the company sold down its existing inventory to meet the surge in demand from the expiring U.S. tax credit, and that the company is still, on a production basis, fundamentally shrinking. The second issue is that sales of other models, which includes everything that isn't a Model Y or Model 3, are not growing. This indicates that the company hasn't been able to expand its sales outside of its two core models, with the Cybertruck in particular failing to make a significant impact. These are important points to consider. They suggest that while the Q3 number was fantastic, the underlying production trends are not as healthy, and the company is still overwhelmingly reliant on just two aging vehicle platforms for all of its growth. And that brings us to the Cybertruck, and a very strange story that has emerged this week. According to multiple reports and sightings, hundreds of new Cybertrucks have been spotted being delivered to Elon Musk's other private companies, SpaceX and xAI. The Cybertruck lead engineer confirmed this, saying that both SpaceX and Tesla are replacing their internal combustion engine support fleets with the electric pickup. On the surface, this is a great story of synergy between Musk's companies. However, this comes at a time when the Cybertruck has been a clear commercial flop. After planning for a production capacity of over 250,000 units a year, Tesla is currently selling the truck at a rate of only about 20,000 units annually. The company has repeatedly had to build up inventory to keep the production line running. So, the timing of these massive fleet purchases by Musk's own private companies is, to say the least, very convenient. It's highly likely that SpaceX and xAI placed massive, non-refundable orders for these trucks before the end of September, to take advantage of a provision that allowed them to still claim the $7,500 tax credit for deliveries in the fourth quarter. This looks like a classic case of using intercompany sales to prop up the delivery numbers for a struggling product line and to help smooth out the expected demand cliff in Q4. It's a move that certainly helps Tesla in the short term, but it doesn't solve the fundamental demand problem for the Cybertruck itself. So to sum it all up, the AI hype is in full swing, with a new must-own rating from Wall Street and a focus on the upcoming earnings report for any and all AI-related updates. A closer look at the record-breaking Q3 delivery number reveals that production was actually down year over year, and the company is still heavily reliant on just 2 models for all its sales. And finally, it appears that Elon Musk is using his private companies to buy up hundreds, if not thousands, of struggling Cybertrucks in a move that looks designed to artificially boost delivery numbers for a failing product. This brings me to my question for you. What do you make of the Cybertruck fleet sales to SpaceX and xAI? Is this a smart, synergistic move to get more of the company's own products on the road and replace its gas-powered vehicles? Or is it a concerning example of financial engineering, using intercompany transactions to mask weak consumer demand for a key new product? Let me know your take on this very interesting development in the comments below. As always, if you found this breakdown valuable, please hit that like button, subscribe to the Tesla Stock Podcast, and be sure to turn on notifications so you never miss an update. Thanks for listening, and we'll see you next time.